Hi guys. We all know that equity markets is one of the best asset classes to generate longer term wealth. Now I did one analysis and you would have seen many such analysis. This is taking the Sensex data from January 91 till date. If somebody were to start SIP of 5,000 rupees and did a step up SIP, which means every year you increase your SIP amount by 10%. So for the first year it will be 5,000, for the next year it will be 5,500, and so on and so forth. So over the last 25 years what you would have totally invested would have been about 1.5 crore rupees. Your profit would have been about 5.8 crore rupees. So the total portfolio size would have been 7.3 crores. This is absolutely phenomenal, right? But it sounds very simple, but it's not that simple. We all know why it's not so simple, because equity markets have corrections every now and then. Now this is the chart which shows us the equity markets drawdown, Sensex drawdowns from January 91 till date. And what this tells us is that we have a 10% correction every 3 years, a 20% correction every 5 years, and a 40% correction every 11 years. Since last 25 years we have seen a 40% plus correction 3 times. Now the 4th time, why it's not showing in March 2020, which was the COVID, here it's just showing 30%, but the actual correction during the month was closer to 50%, but it's only the pullback was very sharp, and when the month ended, it ended at around 29% correction only. And that's why the figures that we saw, the portfolio value of about 7.3 crore, I discussed, it sounds simple, but it's not simple, because you have to hold on to your investments all throughout these corrections, and not only hold on but keep investing. Now let's see. I wanted to take you through the longest correction we have seen till now. This happened from August 94 till August 99. So it was a period of about 5 years, about 61 months, where markets were just did not make any new high, right? So let's consider a case if somebody were to start investing in August 94. And why I'm showing you this is because over the past couple of months, since September 24, when the markets made a high, markets have been correcting, and some of the large cap stocks are down 10-20%, whereas small and mid cap stocks are down even 40-50% as well, right? And we are seeing a lot of data that people are now stopping their SIPs. So that's why I wanted to show you this analysis, that what would have happened if you continued your SIP during the longest bear market we have seen in India, which lasted for more than 5 years. So your monthly SIP, let's consider a 10,000 rupees. So over 61 months, you would have invested 6.1 lakhs. Your point to point Sensex returns would have been zero, exactly zero. But your total portfolio value would have been 8.5 lakhs because you would have made some profit. Why you would have made some profit? And this profit would amount to about 13% XIRR, which is very healthy. And why? Because if you see this chart, look at the blue line. Blue line is the Sensex, whereas the orange line is the average investment price during this whole 61 months, because some of the investments you would have made above it, but many investments you would have also made at 3,000 or below 3,000 price. So overall your average would have been about 3,500, and your XIRR on during this 5-year period would have turned out to be 13%, pretty healthy. Again, not so easy, because had you been at the end of first year of your investments, you would have been sitting at a loss of about 11,000 rupees. If you see year 2, you would have just made your portfolio would have been roughly equal to the money that you would have invested, zero returns at all. At that time, the thought in many investors' mind would be ki, let's stop investment in equity market and let me just put it in FD. At least I'll get some returns without taking any risk at all, right? And this is what happens when the equity markets actually recovered all its losses and made a new high, right? So it's only towards the last 5-6 months that you would have seen most of the gains. Otherwise, your investments, your average investment would have been somewhere around the money invested only, and you wouldn't have seen any gains for close to 5 years. That's why it becomes very difficult to keep investing, but at least the longer term data tells us that if you were to continue investment during those bear markets, it will actually yield very good returns over longer run. Many people tell me that the strategy that they are following is that currently the markets have corrected, so they've stopped their SIPs, but when the markets again start rising and starts recovering their losses, they will again start those SIPs. So I did this analysis that if you were to stop your SIP whenever the markets have corrected more than 20%, right, and again not only restarted, but all the SIPs that you have missed in the meanwhile, you will again consolidate that money and put it in the market when the bear market has the overall correction is less than 20%, then you will again put back the money. Now in this case, again the total investment amount would be same 6.1 lakhs, but here your returns or your total gains would have been less than the previous case when you were not timing at all. So in this case your total gains are about 2.3 lakhs, whereas in the previous case where you were not trying to time the market, there your gains were about 2.4 lakhs. It's not a big difference, but the point being that here you are trying to time the market, you are putting in some sort of effort, but still your average investment cost is not coming out to be as low as in the previous case. In this case your average investments would have been at somewhere around 3,800, right? So this is the final bottom line, and why you shouldn't really try to time the market and just be disciplined, because at the end of the day a disciplined investment, it smoothens the volatility and averages out the overall cost of investment. It's less emotionally taxing. You don't really need to time the market. If you just keep on doing in a disciplined way, then it becomes a very stress-free and simple way of investments. And that is why currently all the investors that are talking to me, all our clients, one thing that I am recommending is do not stop your SIP. Rather, if you have money, this is the time where you should actually try and increase your SIP. Thank you.